Yeah, that looks like a rejection to me. Alright everyone, Cowboy Trades here. Welcome back to the channel for another update on Bitcoin and the markets. So the October CPI report may just surprise the Bitcoin bulls. We have just got the new PPI inflation numbers come out today, and tomorrow we've got the CPI numbers. So I want to talk about how I think this is going to be affecting the markets. We're going to be focusing on Bitcoin a little bit later on. We'll be talking about what's happening in the equities and bonds, and also a little bit later on in today's video I'm going to be talking about a liquidity theory, something to do with the Bitcoin halving. Is it as important as everyone says? Let's just jump right into the price action. So as of right now, Bitcoin is down. Bitcoin is crashing about 2.5% as of the time of recording on the daily time frame, and this is due to the fact that inflation keeps on coming up. What a surprise. We've been talking about this on the channel. Today we had PPI. US PPI year over year was expected to come in at 1.6%, skyrocketed all the way up to 2.2%. US core PPI was expected to come in at 2.3%, all the way up at 2.7%. And the month over month increases on these were 0.5 and 0.3% respectively. So while producer price inflation is definitely important, CPI tomorrow is going to be what the markets have their eyes on. They've obviously strongly reacted to today's PPI numbers, but coming in tomorrow, CPI is going to be where everyone is looking at. Now, the markets are currently expecting for year over year CPI to drop from 3.7% down to 3.6%. I think they're going to be disappointed tomorrow. As we've been discussing on the channel, up until about December, the CPI index is completely flat. So we keep on seeing these 0.3%, 0.5% increases in inflation here, there, in different indexes. So it's going to be no surprise to me when we do see CPI inevitably come back up tomorrow. High PPI is also going to bleed into high CPI. Of course, if producers are getting inflation, they're going to offset some of that inflation to consumers. I don't want to spend too much time in today's video talking about the CPI numbers. As you know, if you've been watching the channel, if you've been a veteran, I've lined out all the reasons why I think CPI has bottomed, and we're going to see it, continue to push back up. I personally think around about 5.6% is where the CPI year over year is going to be coming into December. Now, at this moment in time, CPI year over year is coming in at 3.7%. I think we're just going to continue on the exact same path that I've outlined for the past few videos. I think we're going to continue seeing increases month over month of between 0.3 to 0.5%, meaning I see CPI tomorrow coming up to between 4 to 4.2%. Now, I'm sure I don't need to tell you this judging by today's PPI numbers, but of course, I don't think the markets are going to like that, and I'm going to let you know exactly where I think Bitcoin is going to be moving based on tomorrow's CPI numbers. But before we do that, the secondary head and shoulders that we outlined in the previous video is starting to look a lot more convincing. You guys remember we had a head and shoulders pattern drawn just like this with a price target all the way down here at 18,300. This was the head and shoulders on a ascending neckline holding up all throughout 2023, which has broken to the downside. However, right now, this one is another one which is forming. It is looking very, very convincing right now. As we talked about in our two most recent Bitcoin videos, 9 days ago and 2 weeks ago respectively, we were seeing this head and shoulders start to develop. We were coming into the 200-week moving average, coming into the bull market support bands, coming into the weekly EMA ribbons. And to me, it seems like we've got that clear reversal of trend. If we're just, for example, looking at the bull market support bands previously, you can see back in June and July, we clearly came down. We came down very, very close to touching this before having a solid touch point on the bull market support bands. We were solidifying a short-term bullish rally back up to the upside. What we're seeing right now, in my opinion, is pretty much the exact same thing, but on the inverse. If we invert the scale, you can see, once again, if we just imagine we're looking at the same chart, we've come down to the bull market support bands. We're holding them as support, in my opinion, on the inverse chart, of course. And just like we saw the inverse of this back over here, I think this means we're very, very likely to see a clear reversal of the trend right now. Of course, we were looking at the inverse chart, coming back to reality. This would mean we'd be coming back down to this neckline of the head and shoulders that is forming since 24,530. How quickly we come down to this price target is really down to how brutal tomorrow's CPI numbers are. If it comes up to 4%, then I think it could take a little bit of time. If we do just see a monumental rip to the upside in terms of CPI tomorrow, I definitely think we could be coming down to these price targets very, very quickly. Now, before we dive into the micro, I want to quickly update what is happening in the macro. As you can see, we've got a very nasty bearish engulfing candle happening on the weekly time frame, and pretty much all of the charts which we've been outlining letting you know that we are in a very critical decision point at this moment in time. I believe it was 2 weeks ago we said this week could deliver a massive shock to the markets. As you know, crystal ball sometimes a week or two off. We were about 2 weeks off on this one. This is the critical shock that's happening to the markets right now. This is the surprise that's coming. And I think with tomorrow, the CPI report is just going to solidify that even further. We are clearly in a macro position where we've come back up to this horizontal previous support, flipped as resistance. We've rallied up to this. We've rallied up to the 200-week moving average. We've rallied up to the bull market support bands and the weekly EMA ribbons. And just look at this. This is a clear directional trend in my opinion. Remember, in the macro, it's very simple. Head and shoulders price target down here, 18,400. Of course, there is a CME gap to fill down here at 20,250. This is very important. I think within the next month or two, we could definitely be back down at 20,000, lollygagging for a little bit longer around this range before we do break down into new bear market lows. If we come over to the daily time frame, you can see we have had a few SFP patterns develop. Obviously, we can see that this falling wedge has already completed. We broke down, we came to the price target of this already. But, you know, following this, you can see that we're still respecting these trend lines. We respected this trend line here, we respected it here, we had a consolidation phase here, and we had a swing failure pattern right here where we pushed up. As you can see, this is where we came into the 200-week moving average, the top of the bull market support bands, weekly EMAs, and this is where the rejection has been solidifying for the past few days or so. And as you can see, we are having a throwback. Now, at this moment in time, there's a few different ways you can draw this. We are technically at one level of support, round about 26,500. I'd personally really like to see this floor get violated, and at which point I think these levels down here, the neckline that we talked about, around about 24,700, I think that's going to be an absolute magnet, because if we do now come over to something like the 4-hour time frame, I believe we posted this over on Twitter, we may have talked about it in a video, but as you can see, this was a SFP pattern. This was the top of the range in the bearish trend up at 28,130. We managed to push up a little bit higher. This is where we saw in the higher time frames coming up to things like the bull market support bands, 200-week moving average before. In the lower time frames, we said, no, we're going to get a reversion. We're going to move back down to the downside. And as you can see, the most recent local low that was formed when we broke down to 24,900, let's just call it 25,000, when we capitulated all the way back down here in September, fully completing the head of this head and shoulders before rallying back up to the upside and forming this potential right shoulder on this beautiful flat head and shoulders pattern. Absolutely textbook, unlike the ascending head and shoulders that we talked about before. I know not everyone's a big fan of the ascending head and shoulders. My take on this is, it's going to sound crazy, but if you just look at the chart, rotate your head to the left, maybe 30-40 degrees. It's a head and shoulders. If you rotate your head, it sounds funny, but the head is actually higher than the shoulder if you rotate your head. It sounds ridiculous, but guys, it's market psychology. We're looking at the peaks and troughs in the markets. We're looking at market sentiment. If it looks like a head and shoulders, if it acts like a head and shoulders, it's a head and shoulders. But anyway, for the textbook trader who's pulling up Investopedia and saying, Investopedia says the head has to be longer. I know. This is the textbook head and shoulders that's happening right now. Clear left shoulder, clear head higher than the left shoulder, and as you can see, we've come down to this neckline a few times now, and it looks like after forming this right shoulder and having these macro rejections that we've just talked about, this is where we're going to be coming back down to. I think we're going to be coming back down to the neckline at 24,800 approximately. I'd really like to see 26,500 get broken as soon as possible. Potentially, give it 24 hours or so. Let's see how the CPI comes out. If we do get really aggressive CPI higher than 4%, I think we could quickly smash through 26,500 and start heading down to 24,750, 24,800 immediately. Now, on the 4-hour time frame, like we talked about, daily time frame here, SFP. This was an SFP above these previous resistance trend lines. On the 4-hour time frame, this was an SFP above the 28,130. And like we just mentioned, in my opinion, this uptrend is kind of gone. I don't really see any levels at this moment in time since the most recent local low at 25,000, which are going to hold, very strongly. there is an argument to be made 26,000 might be a little bit hard to break through within the next 24, 48 hours. I would agree with that, but you know me, I don't really look at the lower time frames. I don't really say, hey, this is going to happen in, 4 hours, 8 hours, 12 hours. We're looking at the macro here, and even though we're looking at the 4 hour, I'm just letting you know that the most recent uptrend that was starting from about 25,000, it's looking like it's broken to me. I mean, you can see, we hugged this level. We had a little bit of a bear flag on the 1 hour time frame, and now you can see that we are just absolutely sliding through this uptrending line of support flipped as resistance at this moment in time. So 26,000 could be a quick pit stop before coming back down to 25,000. Now, here's one new theory that I do want to talk about in today's video. A lot of people have asked me recently, obviously, if you watch the channel, I'm predicting a recession. I'm not going to go through all the reasons why I think we're going to have a recession. If you want to learn more, I think we literally made about a 32-minute video comparing many different charts, not only from a technical, but from a fundamental perspective. In this video, are the markets repeating 2008? If you've watched that, you know my thoughts. This is a macro video. Nothing has changed in that regard, apart from a few minor details we will touch on a little bit later on in today's video. But one question that I get asked is, what happens if a recession coincides with a Bitcoin halving? Is Bitcoin just going to disregard global liquidity? Is it going to disregard the S&P 500 and a recession just because previously halvings have marked the start of massive bull runs? Well, here's an interesting contrarian take on this. What if halvings aren't as important as we previously thought? Now, don't throw rocks in my window. I think halvings are important. Halving minor rewards is clearly going to have a positive impact on the supply, which in turn will have a positive impact on the price. But what if underneath the surface, there's something more important than halvings happening at these key dates? And that's what I want to talk about right now. So look, as you can see on this chart, 2012, 2016, and 2020, halvings occurred, price went up. Is this 100% causation, or is this maybe 50% causation and 50% correlation? I would argue the latter. Let's come over to this chart and let's see a very interesting chart. What this does is it compiles the M2 money supply of the Fed, the ECB, and the BOJ and overlays it on this chart on Bitcoin. Now, what you can see is drawdowns in the M2 money supply has clearly had negative impacts on Bitcoin. I mean, we all know this, right? If you watch the channel, we talk about how important liquidity is and how Bitcoin, even though it sometimes may lag by a few weeks, it will track global liquidity. As you can see, the highs in the M2 are followed by highs in Bitcoin, literally every single time. And right now, the year-over-year change in the M2 money supply is about 30% from the peak to the low. A lot of crypto gurus seem to think quantitative easing is coming back. A lot of these crypto gurus don't know what they're talking about. Now, while the M2 year over year for the Fed is in negative territory, if we're looking at the M2 growth of the Fed, ECB, and the BOJ all compiled in one chart, you can clearly see, while it's not at zero right now, it is very close. We are seeing a decrease in global liquidity, just like in this one chart that we've been detailing on the channel for quite some time now. Global net liquidity has been breaking down into new bear market lows. The previous video, we were talking about how Bitcoin was disregarding that global net liquidity. Is that healthy? No, it's not healthy. Of course, we were saying Bitcoin is going to follow that global net liquidity. It is going to come back down, just like what is happening with liquidity right now. And this is just one more reason that affirms my opinion that Bitcoin is going to follow liquidity. It's going to follow the rate. It's going to follow the bond market. It's going to follow the M2. At the end of the day, Bitcoin halving, very important. Is it going to matter if we're in a recession? If you can't go to the store and pay for eggs and bread and food, and you're hungry, and you can't buy drinks, and you're broke, are you going to be buying Bitcoin? No. So when people say Bitcoin halving is just going to disregard global liquidity, I would definitely disagree. So what's my take on this? Because previously, as you can see, Bitcoin has actually rallied into halvings. If we look at from the low to the halving, you can see, this was a rally of 13 months before we even had the halving. This was a rally of 19 months before we even had the halving. This was a rally of about 3 or 4 months before we had the halving. What this means to me is the halving, which is likely going to take place around about April 2024. Remember, not a crystal ball. We don't have an exact countdown of it. It depends how fast we mine the blocks, etc. But the halving, which is going to take place in approximately April of 2024, I think this will have a bullish impact on the markets, but I'm of the opinion that a recession is going to take place round about Q1 of 2024. And here's what I think it could look like. A rough drawing, Bitcoin coming down to these levels that we've been talking about, maybe 12, 14, 10,000 at the lowest in my opinion. I would not be surprised to see it come down to 10,000, back up to 20,000, come back down to something like 14,000, and then at some point, coming into Q2 of 2024, blasting off into a new bull run. So to summarize that, is the halving important? Yes. Is liquidity more important? Yes. Do I still think the halving is going to be bullish? Absolutely. But I think following the liquidity is going to be more important. I think we're going to likely have a recession and a drawdown in liquidity until, Q1, Q2 of 2024, and until that liquidity flows back into the markets, which I think is going to take place round about Q1 to Q2 of 2024, coming into that recession territory. I don't think anything's going to materially change in the macro for Bitcoin. So let's wrap up today's video on what is happening in the rest of the markets. In terms of the S&P 500, we have almost beautifully come down and hit the price target we talked about in our last video. We're about 0.5% away from hitting that price target. In my opinion, we came very, very close to this target. So I would be looking at this as a complete diamond top formation, half diamond top formation to be specific. As we have completed this target, you can see we have had a slight rally back up to the upside. We are, in terms of the equities since the most recent top, making highs, lows, lower highs, lower highs, lower lows. I think this is going to be a brutal lower high, much lower than the previous lower high at 4,521. We're all the way down at 4,350 right now. I think we're still in that same ebb and flow. Like we talked about, I believe it was about a month or so ago, we were coming into this ascending trend line, following this ascending channel. We touched some very, very important levels, and the S&P 500 has rolled over since then. In the macro, I'm looking at the equities, the S&P 500 coming down to 41,022. And in terms of the IWM, wrapping up on the rest of the markets, small cap stocks are getting decimated. The IWM, unlike the S&P 500 counterpart, is only 7% away from making new bear market lows. And the iShares TIP ETF, another one of these very, very important charts. We're going to keep it simple for what's happening in the macro today, because some of these charts, very, very simple, but very, very powerful. The iShares TIP ETF has been plummeting into new bear market lows as the yield curve remains in inverted territory. Bonds are still rushing to the upside in the macro, of course, maybe not the daily time frame. This is why the iShares TIP ETF, the bond market, is getting absolutely crushed right now. And this, of course, the bond market is a leading indicator for global liquidity. The bond market is arguably the most important market in terms of liquidity. Pair this with higher inflation, pair that with the fact that the Fed is probably going to keep on raising the rates if inflation does not come back down to their 3% mandate. And yeah, this kind of leaves us to looking at the next 24 hours, all eyes on the CPI tomorrow. Is it at 4%? Is it at 4.12%? It doesn't really matter. CPI is still on a very, very clear uptrend. So for today, my friends, that is all I've got. As always, if you did, you know what to do. Smash that like button, leave a comment, turn notifications on. If you want to further support the channel, feel free to click the join button and become a member today. New videos coming in 2023. New video in 2023. Dana maybe tomorrow. It's been your boy Cowboy Trades. I'm out. Peace.